Hello and welcome back to Smart Money Mondays. I'm Victoria Elias, also known as the Money Coach. Today's key to financial success is understanding Payslip Deductions. So before we dive into that, let's remember that we're just having a discussion and it does not constitute financial advice in any way, shape or form. So typically when you're done with varsity, you're now entering the workforce and you would go for an interview. When you are rendered the successful candidate for that interview, the company would make you an offer. That offer is called a cost to company. That cost to company is the amount of money or the remuneration that the company is offering you for the services that you'll be rendering to them. Your cost to company is normally shown in annual terms on your employment contract. So then what is a payslip? A payslip is a document that your employer would provide you as the employee that stipulates the remuneration due for a certain period. A payslip will show you your gross salary, which is your monthly cost to company, less any mandatory deductions. Typically, a payslip is meant to help you as the employee understand how your salary or how your pay was calculated, and it helps to create transparency between the employee and the employer. So it is very important that you understand what goes on your payslip and don't just accept whatever amount gets deposited into your bank account at the end of the month. So let's break it down. What will you see on your payslip? Firstly, you will see your gross salary. Your gross salary is the gross amount or the big amount that the company owes you, and this ideally comes from your cost to company. That is the very first item that you will see there, and it is a credit or it is a positive, right? So it is money that is due to you before any deductions. Then your deductions will commence. What deductions will be there? First up, we have income tax. In South Africa, the South African Revenue Services levies tax on income that is earned. So every person that has a job that earns money in South Africa is liable to pay income tax. So the company that you work for is liable for this income tax. So that means that they have to deduct this income tax from your salary before they pay it over to you. That is why it is called a mandatory deduction. Now, how is this income tax calculated? The income tax is calculated as per the tax tables. So you should constantly look at those tables to see which tax bracket you fall under. When you open up that document, it will have an explanation on how it works. Maybe we'll also cover it in a different section, but just know that the very big or the very first deduction that you would see is income tax, and everyone that has a job is liable to pay or liable for this tax. The next deduction that you'd see on your payslip would be unemployment insurance fund. This is a mandatory deduction for all employed South African individuals. Both the employee and the employer contribute to this fund. This fund is meant to provide temporary relief in the instance of unemployment. So should you lose your job for whatever reason, you will have the ability to claim from this unemployment insurance fund. Bear in mind that they will not pay it forever. It won't be a permanent relief. It's just a temporary relief to provide you like a leeway for you to survive in the form of an unexpected unemployment, like in the case of COVID where people lost their jobs, or in the case of a retrenchment, you will be able to tap into that unemployment insurance fund. Another deduction that you could see on your payslip is medical aid contributions. Some of the contributions or the premiums may be deducted from your salary. So these medical aid contributions ensures that you have access to private health care. It's very important in South Africa to have private health care. So if you can afford it, please make sure that it forms part of your budget, and you make sure that this gets deducted, because you never know when a medical emergency might arise, and you find that those are instances where you tap into your emergency funding. So medical aid contributions help with those medical emergencies that were not budgeted for or that were not accounted for, or just your normal, doctor's visits that you need to do. You won't have to pay that as and when you go visit. It could be covered by your medical aid scheme. Another mandatory deduction would be your pension fund contributions. Many employers in South Africa have an option for you to contribute towards a pension fund or a provident fund. Typically, this would be calculated as a percentage of your gross salary, and it helps you save towards a retirement. Your payslip can also include other deductions such as maintenance, mandatory debt like garnish orders or court orders, where a court order has been issued stating that there is an amount of money that you have to pay each and every month, and it needs to be deducted directly from your salary. You will also see that deduction on your salary. So please do not expect to receive your gross salary in your bank account at the end of the month. It will be the net salary. That will be the amount at the bottom of your payslip. That's the amount that's going to reflect into your bank account, and that is the amount that you work with on a monthly basis to draft your budget. So that is the amount that you'll put down on your budget to say, I have this amount of money, and from this, what can I achieve, or what is it that I need to do? Do not go put down your gross salary, because you will not receive that money in your bank account, and you cannot budget for money that you're not going to receive. That's all I had for today's episode of Smart Money Mondays. Thank you for tuning in. I'm Victoria. See you next week, Monday.